Greetings, this is Professor Brian Lazarus, and in this session I'm going to explain to you the mechanics of an income statement. So to help you understand this concept a little better, behind me I have put up some information and a simplified income statement on the whiteboard here. So let's talk about the income statement now. What is the income statement? Let's look at some terms that I used to describe the income statement, also called the statement of income and expenses, also referred to popularly as a P&L statement, P and L, profit and loss statement. So in the sample here, the income statement should always identify the name of the organization. I have taken the liberty of putting the name of my company, Lazarus Global Business Solutions. Right below that, you have the name of the statement, in this case, income statement. And then below that, equally important, is a time reference. What time reference do you see here? We have put for the month ended March 31st. So when we put a time reference, it helps you, the user of the statement, put all of these numbers in context, because now you know that these numbers are associated with a 1 month period, and the month namely is the month of March. So you can prepare an income statement for almost any period of time. You can prepare an income statement for 1 year, or for 6 months, or for a quarter, or for a month. You could, in theory, also prepare an income statement for a period less than a month, though we generally don't do that. Because if you prepare an income statement for a period less than a month, let's say like for 1 week, for instance, that is too short a time period for the information to be relevant and meaningful. More on that a little later. So what type of information does the income statement contain? Basically, you can see here, the first section is the revenue section. In the revenue section, we show all the revenues that the company has earned during this period of time. And under the revenue section, you can have as many sub-accounts as you want. So for instance, if I were a clothing store hypothetically, and I was selling men's clothes, women's clothes, and children's clothes, I could have under the revenue section a sales account for men's clothes, sales account for women's clothes, sales account for children's clothes, etc. Or since I'm a consulting practice, I can have a different kind of a breakdown. Since I am a service organization, I will not have the word sales, but I will instead, I could use the word fees earned or service revenue. I could substitute that as easily. But if I'm selling merchandise, then I will have sales accounts in addition to the fees earned. Again, it all depends on what type of services I'm providing or what type of merchandise I'm selling. But to summarize, you're going to have the revenue information on top. And then below that, you will have information on expenses. So you could have your cost of goods sold as an expense, and you can have a whole bunch of other expense accounts, salaries expense, rent expense, interest expense, advertising expense, etc. So you would normally list all of your different expense accounts as well. And then you have your net income or net loss. How do we derive that? We take all of our expenses and we subtract that from our revenues, and the resulting number would be a net income if your revenues are greater than your expenses. Conversely, if your expenses are more than your revenues, you will end up with a net loss. So this net income or net loss is what determines the profitability of the company. So if somebody asked me, is my company profitable? I would look at my income statement and see if I have a net income or net loss. If I have a net income, I will say, yes, my company is profitable. If I have a net loss, I'll say, no, my company at this point is not profitable, although I hope things will change in the future. So that gives you a quick overview of the income statement with a sample format. Now, going back to a point I made earlier, when I said normally we don't prepare income statements for a period less than a month. Let's assume for a moment we decided to prepare the income statement for only a week. And let's assume that we are doing this for the last 7 days. And let's further assume that we had very heavy snowfall in the last 7 days. If that's the case, how much sales do you think my computer store would have? Or if I'm selling clothes, how much sales do you think I would have? Not much, isn't it? But I still would have expenses. In other words, my landlord is not going to give me a break on the rent because we had snowfall for a week. I'm still going to have rent. I'm still going to have utilities. If I have a manager on a salary, I still have to pay him or her. So I still would have a lot of expenses for that last week, even though my sales would be very little, my revenues would be very little, and I would probably have a net loss for that week. But to show that net loss just for 1 week would be kind of meaningless, because probably I could make up the revenues over the next few weeks as the weather improves. So again, to recap, the income statement can be prepared for any period of time, but 1 month usually is the shortest period of time for which we prepare the income statement. And the income statement contains information on your revenues and your expenses, as well as your net income or net loss. So that's a brief overview of the income statement. This is Professor Brian Lazarus signing off, and I hope you had an informative session. And as I always like to say, we accountants work our assets off.